Well, we want to definitely be appreciative of everybody's time. So I think with that being said, we should go ahead and get started. So my name's Hayden Harrington. One of your hosts. Dustin and I host the Momentum Meetup that I'm sure many of you guys are familiar with and have attended in the past. And so we've now had to kind of move online. So yeah, with that being said, I'll let Dustin introduce himself and we can get started.
Yeah, I know a lot of you guys on the line. Hey Anton, how's it going? Charlie, Chihiro, Daryl, Ethan, Isaac. Hey James, how's it going? Jose. Um, and I know some of the other. Hey Rebecca, Stephanie, Tyler. Let's see, Jan, Yifan. So yeah, lots of good folks on, and my mom's on. So, uh, anyways, yeah, Dustin, live in Fort Worth. I've been involved in multifamily. Started investing passively in 2012, and started syndicating about 6-7 years ago, and had the pleasure of knowing Hayden a little while, and known, I don't know how long I've known Mark, but it's been a little while. So yeah, it's a great industry, and honored to be working with these guys. So um, yeah, I'll turn it back to you, Hayden.
Well, cool. Yeah, we're joined by Mark Alyn with Greystone Investment Sales. So super honored to have you here with us. Um, we'd like you to just tell everybody kind of who you are, what you do, what your background is. We do have a slide too, um, if people want to follow along too. If we could get that pulled up real quick, and then we'll get started.
Yeah. Well, thanks for having me. I'm Mark Alyn, Executive Managing Director with Greystone Investment Sales Group here in Dallas. We are a team of, I think we have 8 right now, 8 brokers and 6 support staff. Staff is still hanging in there, and I'll get into what we're seeing on the transaction side as far as volume and velocity here in a little bit. But I actually grew up in Orlando, Florida, and went to West Point, the U.S. Military Academy, which kind of took me all over the place, serving in the military. So I was in the Army for a handful of years, and last station at Fort Hood, Texas. And made my way to Dallas in December of 2014. I've been in real estate since 2009. Mostly on the residential side, getting creative while I was still in the military. On a lieutenant salary, finding ways to do deals, whether it be wholesaling, acquiring homes with, wrapping mortgages or acquiring them subject to, which helped me build up a little bit of liquidity. And then I was working with a local community bank in that region, and here in Dallas as well when I first moved here. Long story short, it just got tough to find deals, and I migrated over to a multifamily, and that was about 2015, and started meeting folks like Dustin, Hayden I met recently, but Dustin and some other private syndicators that are local here to Dallas, Fort Worth. And I'm really sorry, I'm at home if you can't tell, so I've got baby crying in the background, I've got dogs barking in the background as well. So anyways, I jumped into brokerage, I guess it was about 3.5 years ago, and it's been quite the ride. It wasn't a bad time to jump in, as, transaction volume and velocity has just been, and specifically in Dallas, Fort Worth, it's topped the nation, year over year. So it's been a good place to be for a broker, and along with investors, just as we've seen this cap rate compression and price appreciation. So all in all, yeah, I mean, I started with Sperry Van Ness when I started in brokerage, and our team it was joint ventured with Greystone about 1.5 years ago. So Greystone is a private company. They are a direct underwriter and servicer for Fannie Freddie. We're the #1 HUD lender in the country, and I think our volume is up, a pretty crazy amount this year. I think we've done $1.5 billion, or we signed up $1.5 billion just last month in HUD loans. Greystone has been a lender for many, many years, and has recently, like many other lenders, consolidated and tried to acquire or bring in investment sales. So we are the Dallas-Fort Worth investment sales team. And again, 8 brokers in total with support staff located here in Dallas.
Awesome. I guess before we kind of jump into questions real quick, just wanted to, we pulled up a few slides from CoStar that were interesting. It gives a best case, kind of a medium and worst case scenario. And, so obviously best case, it's just kind of a maybe minor bump in the road. This is with some moderate downside, and then, this is what things look like, a little more of that U-shaped. So it'll be interesting to kind of see how things unfold over the coming months. I think in general, I don't know as well about the rest of the U.S., but I think DFW will be in a fairly good spot in relation to other parts of the country for sure. So with that, we'll kind of jump into some questions for Mark. And so you're real active. I think you may have been the first person I saw that did a virtual tour out of the DFW brokers. So I thought that I jumped on there. I thought that was pretty neat. You were, asking questions right there of the property manager, and I think people, could type in their questions. So it was neat to have that direct feedback. So what are you still seeing transactions going on right now? Can you kind of talk to that a little bit?
Yeah, I mean, just based on my conversations, I'm hearing that, what I'm relaying to investors is different than what they're hearing from other brokers. So this may not be the same. So there was a year-over-year increase in Dallas-Fort Worth, and I'm going to just focus on Dallas-Fort Worth because that's the market that I focus on and know best. But there was a 254% increase in sales velocity year 1 2020 or quarter 1 2020 compared to quarter 1 2019. So, we were poised to just have a great year on the transaction side, both velocity and volume. And looking at the data, it's now slowed down 87.5%. Looking at April, I know we're very early on in this COVID situation. So I say we're in the middle of the storm. We don't know how the end of the storm is going to look, but just looking at April 1st through the 20th, there's an 87.5% decline. So there's been 2 properties that have closed, 50 plus units in Dallas-Fort Worth, compared to the prior year of, see the number here, 16. We had 16 transactions, April 1st through 20th of last year. So, I mean, that gives you a little bit of an idea how much it's slowed down. I would say we're still doing deals. I think we only had 3 deals fall out of escrow. I think we had 10 in escrow at the time. I thought it was a lot more, but I actually just looked. So we had 3 deals. Unfortunately, 2 of them were mine. But we are still putting deals under contract. I think we put 4 deals under contract in the last 2.5 weeks or so. 2 of those are hard contracts with non-refundable money. Day 1, and likely we'll strike on 2 more contracts, either end of this week or early next week. So deal flow is still there. We did put a lot of listings on hold. We signed up, I think, 6 new listings at the beginning of March, and most of those owners or those sellers were, hey, I don't want to go out to market because there's a lot of uncertainty with rent collections. I don't want to get tied up, spend money, time, and get tied up in a contract that ends up falling apart. So every deal is unique. You have different sellers, buyers, and properties. So it's hard to say that, everything's, I've got various stories and they both go a lot of different directions. So again, every deal is unique.
from the buyer's perspective, are you getting more phone calls nowadays, or has the phone stopped ringing?
Um, no, I mean, it's just buyers that typically I haven't connected with or haven't been interested in buying in a long time. Just kind of reminding me as a broker that they're chasing opportunity. If there are owners that are in a liquidity crunch, that they can help out, they can be creative. So I have had those calls. I would say, like, looking at the entire buyer pool, and I've tried to call every buyer that has purchased a property in Dallas Fort Worth over the last 2 years, just to get an update. Hey, what are you doing right now? Are you just kind of stay in place and wait and see mode, or are you actually, are you pursuing opportunities? Have you looked at any different equity sources? How are you underwriting? So I'm asking a lot of those questions. All in all, I'd say about 20% of the active buyers are still actively pursuing deals. And really, I mean, there's probably even a smaller percentage that, I would say are aggressive right now in this market. And I'm talking, they're opportunistic. It's going to be deal dependent. They're not going to stretch for deals, but if they think there's opportunity, they're going to come all in. I had a buyer make an offer yesterday on a property that we had listed, and we're just kind of, doing some soft marketing. And he came in with 300K hard day one and I said, hey, there's nothing with this 30-day due diligence that mentions COVID, any kind of COVID stipulations. So what if you can't get on the property? He said, that's all right, we're big boys. I'm like, okay. So, I mean, that's at the other end of the spectrum. And then, I'm sure you'll talk about other terms that I'm seeing, but happy to answer that question.
So you got the 300K guy, and then are you starting to see it to where it's no hard money, and you're seeing contingencies and all that?
Yeah. So again, deal dependent. But yes, I think most are structuring longer due diligence periods. I've seen that structured a couple of different ways. Like, I had an offer yesterday with just 60 days due diligence. I've had it, structured, let's say 45 or 60 days, or the earlier of 30 days after the lift of the stay in place order.
Yeah.
So I've seen that as well. Non-refundable money, again, I for the most part, I'm not seeing non-refundable money, but it's really deal dependent. And that's upon contract execution. Timelines are extended. Of course, there's force majeure clauses just to protect, different circumstances if they're unable to access property, or, get the financing that they need. So there's a lot of risk. Deals are going under contract, but I'm not holding my breath because a lot can happen over the next couple of months.
Right.
Regarding economic vacancy and collections. So yeah, they're sizing today, some of them for agency financing, and will they size at the same level or close to the same level in 2 months from now? So that's to be determined.
Got it. What are you seeing on the pricing side of things? Because Dustin and I, we've been going back and forth looking at like CoStar projections of rent growth and stuff like that. And everything seems to be over the next 12 to 18 months, that's going to take a hit. So what do you think seller expectations as far as pricing is going to be moving forward?
So there's still a gap. And again, we're very early on. And I'll probably say this on every question. It's very deal by deal dependent. I've had an easier time striking on the stabilized agency financeable deals versus, the 10 to 15 a door, heavier lift bridge type deals. Pricing has been all over the map. For example, Dustin brought up St. Charles, which we did a virtual tour. That's been unique because we had pricing guidance all the way from 75 to 100% on initial offers. Or pricing guidance. Some said, hey, I'm just not getting there in the number. I'm 75% off the mark. So I'm just not going to submit an offer. We ended up getting over asking price, and we had 2 offers, at or above the whisper. So looking at that deal, Class C deal, up in Louisville, relatively good location with visibility off I-35. It was stable, steady Eddie deal, agency financeable with 80% loan to value with Freddie Mac, and if I mentioned it, 6.5 cap on the T12. So I think that's why we were hitting full price on that, just because it was stable, steady Eddie. But still, talking with a lot of investors, I'd say the good majority, as far as return criteria hasn't really shifted. Talking with most investors, what has shifted is the underwriting criteria. Most are projecting higher economic vacancy in year one. Most are projecting little to absolutely no or even negative rent growth in year one and potentially year two. Some investors are adjusting their exit cap rates just a little bit to hedge against the risk. So seeing a little bit of everything, but if there is any kind of pricing adjustments, I think, most of it is because of the shift in the underwriting. Also, I guess I haven't really talked about the principal and interest reserves, and tax and insurance. So the petty reserves or the lender reserve requirements, we're putting that into our underwriting models now, as well as flattening rent growth in year one, just from a broker's perspective when we're doing BOVs or underwriting deals.
Well, I'll speak for Hayden. At least that's kind of music to my ears that you're, year one, no growth and putting in the reserves and all that. So that's great. Have you? And, we're not very far into this. I guess I get the feeling that a lot of, especially on your hairier deals, people are going to have to get a lot more creative. Have you seen any of that yet?
Let's see. I've seen, so financing contingencies. I had an owner tell me today that they can have a financing contingency that'll be agency financeable. I know that's not very creative, but he says, I believe in my team, and they're at like 86% occupancy. They'll get over 90%.
Yeah.
So, I want hard money day one, he says, but if I can't hit 90% and he can't get agency financing, then it's out. I'm seeing just sellers guaranteeing rent. So, maybe you open up an escrow account and put in the rent for 2, 3, 4, 6 months. We had that on a deal which is hanging on by a thread, but looks like it's going to go through. So he's putting 6 months of the gross rents in an escrow account, and that'll just stay in that escrow account if need be any rent that falls short of the month at closing. They'll just fund out of that account. So instead of taking a big haircut on price, maybe it's a 5% haircut on price because of the collections are starting to drop or something like that. The seller can just fund a small amount in that escrow account. So, if it's a $10 million deal and they're coming off 500,000 or something like that, maybe you put up, 175,000 in escrow or something to that effect. And I'm just throwing numbers out there.
Yeah, sure.
And, if it's for a period of 2 months and, anything that's short, that would just fund out of that escrow account.
Okay.
So, that's about it as far as creativeness.
Okay.
Gotcha. Have you seen the added stress, play a role on partnerships, and maybe seeing more deals come apart because of that?
Not really. I think we're still early on. There's a couple of investors I've talked to who are considering capital calls or going forward with the lender forbearance. I've had one scenario where they just had some back-to-back challenges, and it's a CMBS lender, and that special servicer they've been in workout mode for a couple of months, and unfortunately they just haven't had the best of luck with kind of natural occurring events that have happened with the property. So they're looking to, they look to a bridge loan to be able to get out of that, but they don't have the liquidity for the down payment, and the investors don't want to put it up either. So they're going to look for quick cash close on that. But I think all in all, for the most part, we're still too early in this to see much of those kind of opportunities arise.
Are the just curious on the capital calls, is that in a major metro, or is that kind of out in secondary markets, or if you're able to say?
Both.
Oh, okay.
Yeah, here in Dallas, Fort Worth, and outside as well. They're on the private side, and really, I mean, I play in the, call it $3 to $25 million space for the most part on purchase price. So it's more private in nature, less middle market or institutional. And so a lot of those syndicators are, have 30, 40, 50 investors in their deals.
Right.
And, there are those investors that were taking bridge loans, and maybe they weren't stable to begin with, 80, 85% occupancy. And it was more so timing, maybe they closed at the beginning of the year, was going through reposition, and, now everything is kind of at a halt. They're stuck. So, and they have high leverage. So there is some of those opportunities, but I think they're navigating, at least right now, just with everything coming at them. I have heard of some groups. There's private equity that has come into play, and they're looking for, I think they call it priority equity. Well, they'll kind of recap the deal and take out the limited partners and basically take over with their management, and help some owners out in that situation. So, I mean, if anyone on that calls in that situation, happy to connect you, so you can have that conversation. I don't know I don't really know the details, other than, they're looking to come in and recap and take out the limited partners. If they need some working capital or whatever the case may be, it's just an option outside of forbearance or a capital call.
Right. Yeah. Okay.
Gotcha. Yeah. I don't think anybody's really immune to what we're going through right now, but how do you think Dallas or DFW in general will fare in the long term?
Yeah, I mean, I'm a firm believer in residential housing, and especially workforce housing. So, I mean, our economy is so diverse. Real estate is really, not really macro dependent. You got to look at micro, and I think, when you look at DFW, but you really analyze some submarkets, there's a couple of, I thought I saw an article recently, top recession-proof cities in America, and DFW had 3 of those. Arlington being one of them. But just, it's micro dependent, but you can't go wrong with workforce housing over the long term. We're in a storm. I can't predict how long the storm's going to last, but, we will come out on the other end. And, when you look at all of the other asset classes across the country and what's in distress right now, look what some of the lenders are starting to take back. It's not multifamily. Even the past couple of years, I mean, Greystone acquired C3 Capital Partners, one of the largest special servicers in the country. And, I got a tape of their distressed assets. And when you look at it, it was like Houston, it was up in New York, like upstate New York. It was all retail, it was malls, it was office buildings. So anyways, all that being said, I'm a firm believer in workforce housing and being C-class multifamily, especially for the long term.
I know you guys, I don't know how much you work in Houston. I know you guys had a pretty large deal down there a year or 2 ago. Have you guys, I don't know if you or other people on your team kind of play down in Houston a little bit, but if you guys started to see some, with oil, obviously, and between that and COVID-19, have you guys started to see any opportunities? Or I assume there's going to be, quite a bit of action down there.
Yeah. No, we don't. We have Greystone NAA, National Apartment Advisors.
Oh, okay.
That leads Houston. They're a team of about 8 brokers or so. I think they did 36 transactions. I did connect with them last Friday one of their lead folks over there, their lead brokers, Jordan Emmett. And Jordan said he hasn't seen any distress as of yet. Again, I think it's just far too early.
Yeah, right.
It's pretty, it's pretty dry, like not a lot happening. So I think right now it's pretty relatable to Dallas Fort Worth, at least on the transaction side.
Yeah.
Yeah, our assumption is that moving forward, the scrutiny on the tenant base is going to be really something people pay a lot of attention to. Like for instance, we've seen in a major metro, we've seen, March collections get hit. I think it was 14%, but then in a secondary market, it was even better than February. So I think that has a lot to do with where the properties are and what that tenant base is. So is there anything you guys are going to do to kind of try and understand the tenant base a little bit better moving forward so that you can convey that to investors?
I mean, there's nothing really I've thought about, to be honest. I've had conversations with owners who own predominantly, certain minority dominated tenant demographics, such as, Hispanics that maybe in landscaping or construction. I mean, is there anything specific that you're asking about, or is there anything you have in mind?
I guess I'm just wondering, is this going to be something like moving forward, like this property did well during the COVID crisis or something like that? Is that going to be like standard or something?
Yeah, sure. I mean, brokers will search for anything they can on the back end of this to look to sell a deal. So, and obviously that's a great story. Let's take a look at economic vacancy and the dip, and we're seeing deals all over the metroplex. So, I'm sure we'll underwrite some properties here coming out of this that had a much larger dip in their economic vacancy than those in certain areas that may be stronger, like maybe in North Arlington, versus South Dallas, which is predominantly lower income and higher crime in South Dallas. So, yeah, I think that's something that we'll definitely look at.
Are you guys seeing any people from, I guess, the East Coast? I mean, in general, people from the coast tend to flock to Texas, it seems like, but with the whole COVID-19 thing, are you guys seeing, people that, I guess, own up in the East Coast or something, I guess, reaching out to you guys to see, hey, we want to start having more presence down in Texas. It seems like there's not as many cases up there compared to New York. Have you guys started to see anything like that?
A little bit. I get a lot of calls, especially recently after some of the rent regulations in New York City, even on the West Coast. It seems like a lot of the investors up in New York or up in the Northeast are more family office type investors. They're more cap rate driven, and they just have a tough time buying in general. In Dallas Fort Worth, they can't make the numbers work because they're looking for, they want 6.5, 7.5 caps. Right. But that being said, I think there hasn't really been much of a shift quite yet. Just because I think there's still travel restrictions. They're not going to hop on a plane and come down and tour deals. Sure. So when I look at our escrows or the properties where we're striking on deals, all of those investors have, a larger local presence. They're local. They can get to the properties. They know the micro locations. They're familiar with the market. So I would say that's how it is, at least right now. But, that could change as the stay in place orders lifted and people are starting to travel and move around a little bit.
Okay. Gotcha. So since this has started, the way that, at least Dustin and I kind of evaluate risk has changed because nothing like this has ever come up before. And now there's the potential of it happening in the future. Do you think that's the way the majority of people are starting to look at it? Or do you think the enthusiasm behind, especially investing in DFW, will kind of overshadow the risks that we're dealing with?
So you're asking is is will the investor sentiment overshadow the risk?
Yeah, yeah.
At least right now, I feel like just talking with different investors, I get mix of everything. And it's the same thing with the, like when I think about some of the deals, we're working on, and the sellers who may be a little more motivated to take that 3 to 5% price haircut. Their sentiment is, hey, and again, it's really depending on the profile, but I think I told you guys that I had an investor that looks at their multifamily portfolio like a stock portfolio. So they said, hey, I've had a good run this cycle, and for me, not to take a 3% price cut, I got to look at it like stocks. Like overall, I'm way up. I've had some losers in my portfolio over the years. I've had a lot of big winners this cycle. But anyways, just going back to sentiment, it's been all over the place. I can't really, I've heard all kinds of shapes, the V, the U, the upside down hockey stick. So I think over the long term, buyers are going to be opportunistic. If you were buying in the last 2 years, you're probably still, connecting with brokers, making sure you're still top of mind, you're still looking for deals. Whether it's today, 6 months from now, 2 years from now, you're going to be looking for deals. I think most that are investing in multifamily, again, it's a low risk asset, and, you probably believe in it for the long term, just like I do.
Okay. I don't know. Does anyone have any questions for Mark? Let's see. Okay.
Trying to think what I could talk about.
Well, looks like we answered everything. Here's one from Cameron. How do you manage investor expectations as returns will shift? That might be more of a question for me and Hayden, I guess. But so Cameron, that's one thing that we've so we've been having individual conversations with investors, and we've looked at putting out a poll. I've seen some other people put out polls to their investors in terms of what's given where we are now, what's a target return for you. I think a lot of people are trying to understand what this is, how long is this going to be drawn out, what this is going to look like. So in general, as far as managing investor expectations, communication is key. And I know on the deals I'm a part of, a co-sponsor on, we're constantly out there. We're communicating with our investors, letting them know what's going on, letting them know what our collections look like, letting them know what sort of runway we have on different properties. Fortunately, on most of the properties where we had a good chunk of cash. And on one in particular, we just did a refinance, so that was right before all this hit, so that was kind of nice. But in general, communication is key, and if you're communicating and being upfront and honest and transparent, that's all I think people can expect. Tyler had a question of, you mentioned deals going into contract soon. Hopefully, are you seeing syndicators still submitting offers, or mainly institutions being, it's a little hard to raise money right now?
I would say for the most part, the buyers who are still bidding on deals there is some syndicators that are still making offers. But there's not as many. I've seen that. And for those that are actually a little more aggressive right now, maybe they have 3, 4, 5 large check writers that are like, we'll write $1 million plus check. So there may only be 3, 4, 5 investors in the deal. You know, one of the deals we just went under contract, he's got one guy like that, you know, would write a $20 million check if it was a good deal. So, you know, went under contract with non-refundable money day one. And he said, you know, if I can't get the financing, I'll just close it in cash. So his investor is committed to that deal. So I would say it's a little more, more so private investors with their own money, or syndicators that have a couple of deep pocket investors, or maybe backed by a family office.
Yeah. Austin had the question of thoughts on mom and pop deals in this current environment. More opportunities, they're getting hit harder than the institutional investor.
Yeah, I mean, there's talking with one mom and pop investor that's out of state. You know, when I was asking and sharing information about rent collections, he said that everyone else was, you know, 75 to 85% collected, maybe plus at that point. I'll call it 75 to 95% collected. This was kind of early on in the month, and he said, "I'm 60% collected," and he wasn't in a bad area. And you know, he's kind of an elderly gentleman. So I think there may be, you know, those that just want to exit here in the near term, as you know, they're getting up there in age, and you know, they're managing the property. It's just hassle. Do they want to ride another cycle? I've heard that. So yeah, I think there are some mom and pop deals that'll likely come out here, you know, in the next 12 months.
One question I had is, I don't know if you've gone during this period, if you've gone through a appraisal or if you've gone through any due diligence. You know, I guess, can you speak to that? I heard of another broker saying that on due diligence, instead of going in the units because the tenants didn't want the people, and the you know, the people didn't want to go into the units and all that, the seller just put up $500 a unit into escrow, and that was, they agreed that they were just gonna, you know, roll with that. What have you seen, or if, I don't know if you've been through that process over the past month?
From third parties for the lender inspections, they've been virtual.
Okay.
And there's affidavits that have been signed, and I think they'll come back through at a later date and review. I haven't seen what you were just talking about, Dustin.
Okay.
You know, for the deals that I'm striking on now, the due diligence hasn't happened. They're moving due diligence out after the stay in place. So,
right.
Well, I shouldn't say that the physical due diligence isn't happening, but they're still getting, you know, if the leases are on file, which most of them are at the properties and the properties that I'm selling. Or if, you know, they're going to look at surveys and some of the other typical due diligence items that you get up front that you can start to inspect and look through.
Okay.
Matthew had a good question too. What do you recommend for new deal sponsors to better connect with brokers and sellers, to build relationships, to have a better visibility for the deals coming out on the other side of this?
Yeah, it's tough. I mean, at least in Dallas County, hopefully we're out of this and we're back in action and can hold momentum meetups in Las Colinas here in the next, you know, 15 or what is it? I guess 25 days now. You know, I think phone calls and emails and just, you know, I'm likely, at least this time, I'm just sitting in here making phone calls in my office. So I'm not doing much other than that. Maybe I'll sit on a webinar once a day, but you know, so not to say I won't call you back, because I have the time right now. So yeah, I mean, phone calls is fine, and sending an email. Someone said, hey, never connected with them today. They're actually out of New York looking to come to Texas. I know that was one of Dustin's questions, and they said someone, you know, said I should reach out, and can we set up a time to connect? That's probably easier, because honestly, I'm on and off the phone all day. So if you just send me an email, I'm happy to schedule a call and just hop on for an introduction.
So Anton,
I'm sure that's the same for most brokers.
Yeah. Anton had the question of, do you foresee within DFW some submarkets weathering the storm better than others? And if so, which ones?
Yeah. I mean, Anton, you've been around, So, I mean, when I look at Yardi or CoStar, and you can see the history of the property, who's owned the property, and some of those properties have special servicers, REOs. So where's the concentration of REOs and foreclosures? Well, in Dallas Fort Worth, it's in South Dallas, areas in Mesquite, Southeast Dallas down into like, Duncanville and DeSoto. Then you can look at, areas in Grand Prairie were rough. There was a lot of like central Arlington. Not a lot, but some, at least from what I heard, a lot of the Hispanic demographic, when there was no construction work, they left and went back to Mexico to go find work, or I shouldn't say to Mexico, but they're, wherever their home country. East Fort Worth was another one. There was a lot there, kind of west and east of 820 and just north and south of 830, like the Meadowbrook area. West Fort Worth, kind of like south of I-30 there. There was a lot of REOs there. So, I mean, just the areas that are typically a high 20 to, 30,000 median income type area with higher crime rate.
Got it. And Julia asks, what's a realistic return investors should be looking for on B and C class multifamily, cash on cash return, IRR? I think personally, my personal opinion is it's really dependent upon the investor themselves, what they're acceptable. You've got to look at what can you get in other asset classes too. Right now, you don't have a whole lot of good options there. I don't expect cap rates to expand that much. Mark, you can definitely expand on that, but I think it's really investor specific.
Yeah, it's investor specific. So, each sponsor may have investors that have return thresholds of 6%, or maybe 8%, or maybe double digit. Some may be looking for capital appreciation. They may not have any kind of distribution in year one or maybe even year two, but they're looking for the big pop on the exit. So it really just depends on the sponsor and their strategy. And if you're an investor that wants more, certain strategy like wealth preservation, then you're likely going to go to a sponsor that's buying like core assets that are higher quality in really good locations. And maybe you're only getting a 5% return, but that's a really stable, long-term, hopefully steady asset.
So Eric had the question of, do you see 2009 vacancy rates coming back in the near future? And I'll throw in my 2 cents. I think, and it's going to depend on what metro you're in. And then within the metro, it's going to depend on what pocket, is Anton and Mark were, speaking of. But, I think in general, I think, of the metros around the US, DFW is going to, fare as good or better than, any other metro. Just in terms of diversity, we've had tons and tons of people moving here. We've had the size of Waco moving in every year, about 100 to 120,000 people. So I think just in terms of that, those trends are only going to help multifamily. There might be, I don't know the vacancy rates from 2009. We may see some dips, and all of DFW, as Mark and Anton were hinting at, are not equal. And so I think personally, it's, that's why I, really stress buying in lower crime areas. Just, when we come into times like this, that's when, the higher crime areas just don't tend to fare as well, unfortunately. So Anyways, I'll turn it over to you, Mark, and you can throw in your 2 cents.
Yeah, I mean, I guess my response would be if I knew the future, then I'd probably be a wealthy man. Wish I could predict it, but I can't. Yeah, I mean, that's the big question right now. Is this going to be, a 6-month ordeal where we bounce back and things are back to normal, or is it going to last, 2 years or longer? No one knows.
Yeah. And then we get a question. Has anyone had experience using Locator service trying to find tenants?
I don't, we haven't really used one. It seems like I guess we just use, we're mainly C class. And so it's been Craigslist or Facebook Marketplace for us, or just traffic. So we've never really had to use a locator, fortunately.
Yeah, I typically don't see them unless it's, B plus quality asset or higher than that. And mostly A quality.
Oh, that's a good question from Austin. What percentage of deals are typically held off market?
I don't know the exact answer to that. I mean, I can look at our deals and tell you that I know 2 years ago we were 55%. I'm not really sure what we were in 2019, but it hovers right around half of our deals in the B and C class space. And, that's going to be different from shop to shop, but overall in the market, I think, Todd Franks is, my business partner and been around for about 20 years. And Todd will tell me, like, he's never seen this in the last 2 years. He's like, these deals are trading like stocks. Like, people are throwing out, blind offers, like not knowing anything. And he's like, I've never seen it before in my career. It's incredible. So again, there may be a time, especially as sales velocity starts to slow down, we'll see some of these off-market deals kind of fall to the wayside. But DFW, I've heard Houston's the same way, has been a really dominant, fast-moving market that has been dominant off-market.
Yeah, I've heard Houston's about half off market from the brokers I've talked to down there.
Yeah.
Okay. Let's see. Any other questions from folks? Awesome. Well, yeah, really appreciate your time, Mark. Thanks for hopping on, and looks like got lots of good feedback and had good number of people on the line. So it was awesome. Thank you.
Thanks so much. Appreciate you guys having me. And if anyone has any questions or want to connect, I'm happy to connect with you over the phone or through a Zoom like this, and also can connect you with any other members of our team. Some members of our team focus more so on secondary, tertiary markets. So, if you're looking for details or information about what's going on in Waco or, like a Lubbock or Midland, Odessa, happy to connect you with the right person.
And we'll also send out a follow-up email that'll have the link to the recording if you guys want to watch it again. And then also all of Mark's contact information if you want to connect with him too.
Awesome.
Great. Thanks so much, guys.
Thank you, everyone. Have a good day. See you guys. Take care.